were doing the same thing. One week we'd have an article of positivity, next week negativity, and everyone was really on this roller coaster. And what we're hearing now is a lot of positivity, and the property market's expected to have a really strong year, but it is going to be fragmented. Not every property is going to perform the same. And we're also wanting clients to make rational decisions and get the right people around them. That's one of the most important things. And these two articles here were actually printed 3 weeks apart by exactly the same journalist. And she was probably one of the worst ones last year, I think, for creating fear and angst in the community around property and what the property market was doing. But just for a bit of background on us, so we've been in this advisory space for nearly 10 years, and our approach is all around independent advice and putting the right team around people. We think that's the most important part of it. So we use our knowledge, expertise, and experience to make sure we leave clients in a better place than when they came to us. And that's one of our core values. The other part is putting a team around people that can do the right job. I mean, we don't see property investment as an individual. It is really a team approach. And your client advisors, your accountant, your financial advisors, your mortgage broking team, they're the people you want to be leaning on first and foremost to make sure you get the strategy right. And then regardless of whether it's us or any other group, you want to make sure whoever you're working with is an independent team. So that would be a group of people that don't have a vested interest in you buying in a certain area or region or a certain property style, and making sure that they've got a research committee or a team of dedicated research people behind them. So I do need to pay thanks to SQM Research, RP Data, McCrindle Demographic Research, and a lot of other research houses that we lean on for our insights, and then obviously our team here at One Group that do their work as well. I guess one of the most important things to talk about is why property in the first place. And the reason why this event's on as well is because Highview have a lot of clients that have an interest in this. They either hold a lot of property or they've got ambitions to hold a lot of property. And the main thing that they all share in common is they want to get it right each and every time. And we don't all have an abundance of borrowing capacity, and we don't all have an infinite run of cash flow, which means we're all going to reach a point where we stop and go, we don't have capacity anymore. And have we invested in the right properties, and have we done it at the right time? So it's absolutely critical. And tonight's really about getting everyone aligned and on the right page with when to take action and what to take action with. But one of the biggest reasons we gravitate to property is because it's the asset class that we all feel most comfortable with in most cases. And we've generally had some positive growth out of our own homes. And we've heard about family members and friends that have invested really well, or in some cases, and in most cases, when you look at some of the wealthiest people in the world, even if their core business wasn't property, that's generally where they hold most of their wealth. And we're very lucky here in Australia that it's been a very consistent asset class for a very long time. What we saw last year, though, was a lot of uncertainty. And I think what we need to do is cast ourselves back even before last year and have a look at what was happening at the end of 2019 for us to really get a handle on why the property market's so strong at the moment. So I'm going to touch on a number of fundamentals tonight as to why the property market's in the current state it's in and where we think it's heading. And I'm going to delve into as many of those as possible in a 30 to 40 minute time block. So it's going to be pretty quick and punchy. But the first thing we look at here is a graph that shows us the market recovery that was happening at the end of 2019. This was actually the fastest recovery in history. So in 2017, the market peaked, and then between 2017 and 2019, it was a little bit sketchy. And what we saw at the end of 2019, before COVID graced our shores, for lack of a better term, is the property market was quite rampant. And we were seeing a really, really quick recovery. And we're back at the peak of 2017 within 10 months. It's only been pipped by the 83, 84 recovery, which did 11.5% in 11 months. So pretty much splitting hairs. So it was a very, very rapid recovery. And we were really gearing up for a massive first quarter there in 2020. But for obvious reasons, that didn't happen. At the start of the first lockdown, we saw about 40 or 50%, depending on the area, of listings pulled from the market. And there's a lot of uncertainty for obvious reasons. I'm not going to go into much of the behavioral side of last year in a lot of detail, but I will talk about the fact that the property side of it was fearful at the start of the year, but then it became a real divide in the community, and there was different camps. There was camps of positivity and there was camps of negativity. There was people saying that property is the only thing that will survive and perform, and there was others that were saying it's all going to fall apart without immigration and without the ability to move around Australia. But it actually ended up being quite the opposite. When you looked at the amount of stock pulled versus the number of people that were still in the positive camp and wanted to buy, the market was quite balanced and actually held its values. And one of the areas that performed exceptionally well is the regional areas. So we'll touch on that a little bit more. We'll also talk to this immigration, which is a bit of an elephant in the room at the moment. With immigration on hold, what does that really mean for property? So the first thing here to cover off, and we won't be able to go through all of these, but to talk to you around what essentially we believe are the 16 big influences of the property market in 2021. In our opinion, it's going to be a year of growth, but not everywhere. And there's going to be a lot of optimism, but once again, not everywhere. And the end result is it's going to be a very fragmented property market. We'd love to think that it's going to be great for everyone, but the facts are it's just not going to be the case. We also don't have time tonight to go through all 16 of these. So we're going to hone in on what we think are the most important. But just from a very quick snapshot here, if I could just give you some insight, the positive ones, in our opinion, the big ones are low interest rates. Without doubt, the number one driver of property growth is when money's cheap and easy to access. And that's definitely the current climate that we're in at the moment. Affordability and lifestyle drivers. I mean, the rise of these regional areas, which was happening since 2017. 2017, when the market was peaking, was also when we started to see a significant percentage of the population move out of capital cities into these regional centres, generally within 2 hours of capital cities. And we've seen that amplified by COVID. Obvious reasons, working from home, and also that people are looking at life through a very different lens now. And these smaller cities are also getting some critical mass, which means there's a lot of other subsectors that are booming off the back of the bigger sectors as well. So that's a really positive thing to see. Responsible lending changes. So it's a bit hard to see exactly what kind of impact this is going to have, but essentially the changes that the government are putting through means that people will be able to get their hands on money quicker. So the ability for loans to be processed faster and for them to be cheaper to repay means that's going to drive the property market. First home buyers are a huge part of the marketplace at the moment, and they've really taken over from investors. Investors pulled back last year, and even at the moment, a lot of the pre-approvals that are going through, there's a lot less from investors, but there's a lot more from first home buyers. And first home buyers have got home builder grants, they've got stamp duty grants, and they've got a lot of incentives there. And then the banks are also hunting them as well. So it's a fantastic time for first home buyers to get in, and we're seeing that on a national basis. The importance of the family home and market confidence rising. I mean, these are a bit more subjective, these drivers, but they're definitely evident. We see it in all the conversations we're having, and I think everyone agrees that after last year, the importance of having a home that works for family and works for the new way of working is hugely important as well. And that's going to mean upsizing. That's going to mean people are renovating. That's going to mean people are considering moving into other areas where they've got more space. And higher density is unfortunately out of favour for a while, quite a while. If we look at some of the more negative ones, the mortgage freeze is going to warm back up. There's about 250,000 mortgages still on hold based on RBA data. And hopefully those people come back in a place where they can start to make those repayments. But you would have to think there's going to be a percentage of those that unfortunately will need to consider selling. A lot of the building approvals that are coming through now as well, it's pretty balanced, but later in the year, we should see a slight oversupply in certain areas. So some of these building approvals that have been in the pipeline for a little while, we don't have immigration coming through to soak them up. And most of immigrants to our shores are renting in the first 12 to 18 months and even up to 2 years. And some of them rent for the whole 5 years that they might be here if they're on shorter term visas. So the rental market's definitely going to take a hit because of more supply and less demand, which is the simple equations of property. The rental moratoriums, it depends on who you speak to as far as who's had issues with tenants paying rent, but it is an issue in a city. It's a big issue in a city, and there's a lot of tenants that haven't been paying and can't be kicked out. There's a lot of property investors owning assets that they would love to sell, but agents are saying, look, why you've got those tenants in there. It's just not going to be a marketable campaign. Wait until you can kick them out. So when that moratorium does expire, you're definitely going to see a bit of, you're definitely going to see an increase in supply. The big question is how much and where is it going to be? And that's why we say to clients, look really closely at owner-occupier ratios and focus on those areas where there is a higher percentage of owner-occupiers. Tightly held areas where properties are held for a longer period of time. RP data has that data, and you can see anywhere where properties are held for on average 9 to 12 years, they tend to be the best suburbs to tap into. And obviously the phasing out of JobKeeper, once again, there's a divide in the community as to whether that's going to leave a gaping hole or whether the government will continue to extend that, and how many businesses are really using that to survive at the moment. And then I think the onflow to property will take time. Residential property, we tend to see impacts happen very quickly, whereas commercial property, it tends to take a long time for that to reverberate. So stock levels are definitely going to increase on the residential side in some areas. So these are the three that we're going to hone in on: immigration, population, the future of work, and also rise of the regional areas. and how they impact on property and how they're positively and negatively going to impact on property. But we're also going to take a look at some of the high risk strategies as well. So the strategies that we think you need to be very wary of in this particular market. So let's hook in. But before we do, let's take a look at the three different asset classes that we're generally talking about when we talk residential property. We've got houses, we've got townhouses, and we've got apartments. Now, they're not all created equal. There's different advantages and considerations with all three of them. But you can also make significant money with investing in all three of those. And we've definitely got clients that invest only in apartments and have done exceptionally well. We've got clients that would only buy townhouses or do townhouse subdivisions, and they've done exceptionally well. But the general denominator is that houses perform better in the long run. And when you consider that in most middle ring suburbs or established areas, they're knocking over houses to build townhouses and to build apartments. So they're diminishing the supply of houses and they're increasing the supply of townhouses and units. So all it means is you've just got to be extra careful and extra diligent when you're investing in a townhouse or an apartment. It doesn't mean that they're a no-go zone. I definitely believe, based on the data, that apartments in the CBD are a no-go zone for the next 2 years. But once again, it depends why you're buying them and what your expectations are. But if we assume it's return on investment, I think the first two categories are going to be a safer one to focus on. Obviously, there's a price point consideration, there's a cash flow consideration, and there's a portfolio consideration. What have you already got invested in, and what are you going to be using the property for? So once again, lean on your advisors and have a more robust and tailored conversation around those. So immigration and population. It's pretty staggering when you look at the numbers. So nearly 400,000 people a year we grow by. And when you consider that nearly 65% of that is net overseas migration, it was something that none of us were really able to put in context last year. What does this really mean? If no one's coming here, what kind of impact is this going to have on property? And if we look at the forecast for the next decade, we're expected to grow at about 230,000 people. So net overseas migration was expected to be at around 230,000 a year. What we saw last year was negative about 70,000. So it's a pretty drastic drop. And I think the big question everyone was asking, what does it mean in the next decade and beyond? How is this going to impact us in the long run? Well, the fact is we should get back to this level by the end of the decade, which sounds like a long time, but when you consider the numbers that we were growing at and the speed at which we'll grow at post this decade, it actually isn't going to have a massive long-term impact. So the long-term impact of the borders being closed, assuming it's over the next 2 years, and that's what these analysts have forecasted on, we should start to see some immigration happen towards the end of 2021, which is fine because in most cases, we should start to see supply drop off through this year, and then the immigration will come back at the end of the year. So it should only be a small window that we have an oversupply towards the end of 2021 before hopefully the population growth rebounds next year. The other key things to keep in mind is most of this immigration flows to capital cities. And if you break it down even further, most of it flows to Sydney and Melbourne. So Sydney and Melbourne are two markets to be really mindful of. And then when we consider that there's also this flow to the regional centres, we then have to question, well, what's going to happen to the inner city property markets? Houses and townhouses, we don't have a concern with, mainly because they're so sought after. School catchments in these inner city suburbs, lifestyle in these inner city suburbs, it's a very, very good, it's very good drivers. And we've also got these expats coming home, and we've also got interstate migration, which will return sooner than overseas migration. So when graduates out of Adelaide and people that have been studying in Darwin decide they want to come down to Melbourne and be part of financial institutions, or they want to work for the big insurers or the big superannuation funds, they're not going to have a choice but to get down to Melbourne or to Sydney or to wherever those big corporates are based. So what we didn't see last year is we didn't see those people coming to Melbourne or Sydney. What we also saw is a lot of people going home. A lot of people saying, well, geez, if I'm from Adelaide and I'm working in Melbourne, I don't need to be in the office. Maybe I'll just go home to mum and dad's, or maybe I'll go to the farm property. So we saw a lot of that. So a lot of people have left, and they should come back now, especially now that we're open again from a lockdown point of view. And when we start to see more of that interstate migration come back and more of these expats coming home, so Australian residents that are deciding they want to get back to their home, we'll see the property market move on the back of that as well. Because most of these overseas residents that are non-Aussie residents, they tend to rent for an extended period of time. So that's going to be the biggest hurt to the property market, the rental market. We're actually seeing a lot of expats buy property now in anticipation of coming home in the next couple of years. So there's been a significant amount of inquiry come through from Hong Kong, New York. There's a lot of inquiry on realestate.com from Aussie residents that are looking at securing a property now to anticipate a move in the coming years. And obviously the Australian landscape looks pretty amazing compared to the rest of the world with regards to how we've handled this. I think the last staggering thing here to acknowledge is that we're still on track, even with the lockdown on immigration, for potentially an 18 to 24 month period to hit 40 million by 2050. I'm sure for most of us who are on this meeting, we're going to see that in our lifetime. And that's just an amazing figure to get your head around. So when you think about how that translates to property from an urban sprawl point of view, from a density point of view, it is a fascinating time, and it's fascinating to see what this country will look like with that many people. This is one that I think's been debated, and there's many opinions out there as to whether anyone's going to return to the office and what the CBD commercial property market looks like. I'd be concerned if I owned buildings in the CBD, but if I had that kind of wealth, maybe I wouldn't be as worried as what I think I would be. But the city itself is definitely questionable from a working standpoint, because most big companies are too scared to bring people back into the office in full capacity just at the moment. But we can honestly say from the people we're speaking to that run these big businesses, they can't wait to get their teams back. And the teams in a lot of ways can't wait to get back in there to some degree as well. So first of all, if we have a look at how Melbourne, Sydney and Brisbane compare, Melbourne has 76% of its population living in Melbourne Metro. Sydney has 65 and Brisbane has 48. And this is one of the key reasons why when you look at Queensland population growth being really strong, Brisbane doesn't boom, because a lot of the population growth in Queensland is really dispersed everywhere from, Townsville through to Toowoomba, and obviously Sunshine Coast and Gold Coast take a pretty significant brunt of it as well. Because if you're moving to Queensland, why wouldn't you try and live in some of the most beautiful parts more so than Brisbane? Now, I love Brisbane. I think from a city point of view, it's going to be really strong in the next 12 months. It was one of the only capital cities that went up by 3.5% last year. So Adelaide and Brisbane were surprise packets, and they should have another really strong year this year. But you've got to be very particular about the suburbs you buy in. Sydney's already seen this dispersing of population for a number of years now. It's mainly driven by affordability, but Melbourne's generally been okay. As much as it's not a cheap city to live in, we have had a lot of middle and outer ring suburbs that were quite affordable. But as that starts to change, we're seeing a lot of Melburnians consider a move to Geelong, Bendigo, Ballarat, the Peninsula full time, and also into your outer regions, out Pakenham, Officer, and those places down Warragul and Druin. So those outer extremities, anywhere from 90 minutes to Melbourne, we're seeing that they're going to have positive growth next year. Now, obviously, we're not looking just to have a return on investment. We want the best return on investment. So in our opinion, you've got to stick to those townships that have got at least 100,000 people, and then have train access to Melbourne within 90 minutes, and preferably car travel within the same. Now, the stats are interesting because opinions are one thing, but the problem is sometimes our opinions, we can seek out other people's opinions that are similar to ours just to confirm what we want to believe, our biases. But the data says a very different story to what most people are saying. There was a feeling that everyone's loving working from home and no one wants to go back to the office. But the fact is, it's only a very small percentage of people that actually feel that would be the case now, and that's 14%. When you look at the hybrid option, 62%, that's what most people are expecting to happen now, which is probably going to be 2 days in the office, 3 days from home, or potentially the other way around on a fortnightly basis. So the key thing here is most people are looking at their home setups, especially if they're a dual income. Can we make this work? Do we need a bigger footprint? And because debt's so cheap, there is a significant percentage of the population that are considering upgrading and renovating at the moment. So it's going to be very active in the construction space, and it's going to be very active in the knockdown rebuild space. So knockdown rebuild is typically what we see inside about 20 Ks of Melbourne. Old 50s, 60s bricks or weatherboards being knocked over for brand new houses. That's a really big growing space at the moment. We're also going to see a lot more people moving to those regional centres I talked about, being your Geelongs, your Laylaws, and definitely your Bendigos and your Ballarats. So the rise of the regional areas. This is thirsty work. So excuse me while I just take a quick sip. The rise of the regional centres, as I said before, has been happening since 2017, and it's just been amplified by what we went through last year with COVID. And if you have a look at the market performance from March to October, which is really when things are at their worst, it was mainly the regional markets that held up best. And the only anomaly there is WA, and WA's regional centres tend to be connected to mining, and they're struggling to get back to their peaks, and maybe will never get back to their peaks. So the data in WA is a little bit skewed. In saying that, Perth's inner city property market is tipped to have a really strong year. But once again, it's still not tipped to get back to its peaks. So be mindful of property spookers that are telling you to jump on Perth. Perth will definitely have growth, and some people are tipping from a research house point of view up to 10%, but that's still just recovering from where it was. When we look at New South Wales regional's been performing exceptionally well for a long time. And you can see the dark blue is actually the inner city regions. So the inner city have already copped it the hardest. In Victoria, 7% down last year. And then the middle ring and metro was around 5% down. But our regional centres were fairly neutral. So they weren't growing, they definitely weren't declining. And we actually had a lot of Melburnians buying sight unseen in these regional centres for either escape properties or wanting to seek refuge in these markets and sell their inner city properties, which if you think about it, is a pretty drastic move for some. But I also think a lot of people are already considering this move. Once again, the data shows that it was already happening. So a lot of these people that were selling and buying in these regional centres probably had this on the cards at some point over the next 2-3 years, but COVID forced them to make a decision, a big decision. Now, the other side to this is markets that haven't performed very well for a long period of time, had some time in the sun. So you can see here, when you look at the Gold Coast has been declining market since 2015, and it hit its bottom back in about October 19, which is when the property market started to get some traction in Melbourne and Sydney. What happened is it then went on a really significant run last year. So when the borders were closed to all the other states, Queenslanders started to move to these coastal regions, even without being in lockdown, which is quite fascinating. So that showed us that it just started to change people's mindsets a lot around what's important to them, where they want to be spending their time. But we're also seeing a lot of these regional centres are investing significantly in infrastructure. So the Sunshine Coast, for example, has moved their whole CBD away from the coast to an area where they can scale it a lot bigger. They're looking to set up a tech hub, and they're trying to bring some very, very strategic and forward-thinking businesses from overseas into these regions. So they're trying to think differently about their town planning and their urban planning. So these coastal regions are going to perform really well over the next couple of years, but you've got to be incredibly careful what you put your money into. Stay away from big buildings, stay away from off the plan, and really make sure you do your homework. The 7 regions to watch, and I've sneaked in a bit of a cheeky one at the bottom there with Adelaide, which is clearly not a regional centre, but I hope I don't offend anyone who might be from Adelaide. But I put it on there because its price point is conducive to a regional centre. There's some inner middle ring suburbs of Adelaide that are cash flow positive, 450 to 550 price bracket that we think have got some merit. And when you consider that they're not losing the population they were previously Adelaide, so they're not growing excessively, but they're also not declining, because I think a lot more people will decide to stay and try and forge careers back in Adelaide now as well. Also on the back of bigger businesses looking at spreading their risk and tapping into a cheaper talent pool, places like Adelaide and Brisbane are going to be a lot more favourable for them when they're too Melbourne or Sydney centric. But if I start from the top, Ballarat, Bendigo, Geelong, I've mentioned them a few times now. Regional centres with 100,000 plus people inside 90 minutes of capital cities have performed very well for a long period of time, and that's definitely going to continue. There's a lot more movement to happen in Geelong, especially once we start to see some price rises in Melbourne this year. Naturally, Geelong then becomes an area of interest for them. Sunshine Coast, definitely over the Gold Coast by a long shot. They're upgrading a lot of the road infrastructure between Brisbane and Sunshine Coast, but also Sunshine Coast itself has got some significant infrastructure investment happening, and the population growth there is quite strong at the moment. Newcastle and Wollongong, both of those are 300,000 plus cities in New South Wales. They've been somewhat up and down at different points over the last decade, but last 5 years have been exceptionally consistent. Both coastal living and both offer affordability and lifestyle compared to Sydney. So definitely markets to keep an eye on. This one here, I just wanted to talk you through. It shows you the most sought after suburbs for first home buyers. And the reason why this is really interesting is when you break down, first home buyers are really having a crack this year. And when you talk to anyone in a finance game or banking game, they say that first home buyers are coming in droves. Now, Melbourne and Victoria seems to have the majority of the activity, which is really interesting. So these are the top suburbs and postcodes on realestate.com for first home buyers. On the left side is units and on the right side is houses. So fascinating to see that first home buyers are going really strong at the moment in Victoria compared to other states. Now, that can't last all year. There isn't enough first home buyers out there. So I think from a competition point of view, the first 3 to 4 months of this year, it's going to be tough for investors sub 700 in Melbourne because first home buyers are so active. But towards the end of the year or even in the middle of the year, we might see a little bit of change in that. We might see some of these first home buyers have already purchased, and there could be a little bit less competition out there for investors that are in that sub 700. Sub 700, I still think you've got better opportunity outside Melbourne, looking in those regional centres or considering something in inner city Brisbane. A lot of opportunity for freestanding houses in inner city Brisbane around that 700 mark. Stick north side, stick close to Chermside, which is where that Westfield is. And there's really probably 4 or 5 suburbs around there that are really good opportunities, good price point. So let's take a look at some of the areas to be mindful of. Rule number 1 for Warren Buffett, billionaire, one of the most successful investors of all time, is never lose money. And this is the key thing you've got to keep in mind before you get into the market this year, even as an experienced investor, is be risk adverse. The second rule that he has is don't forget rule number 1. And it's the most critical thing, because if you lose money on property, it takes such a long time to get it back. And the areas that we see most people make bad mistakes is around speculation and hype when it comes to new property, and especially when it comes to a combination of new property and dual keys, or new property and national disability schemes. This particular property on the right side here was actually sent to us from a client. They went to their account and said, hey, I'm thinking of buying it. It was being spruiked as having a 15% yield, which is just absolutely ludicrous. The median price in this area is 380 grand, and this package is 630. And this is what happens. People focus on the cash flow and forget that the value is way, way off. And they're overcapitalizing an area where they're never going to get it back. They're buying a property that's very narrow from a tenant profile point of view. And it's impossible to have a contract signed up with one of these providers, being the tenant providers, before you build. So you're speculatively building a home that's for a very niche market without a tenant. There's heaps of risk in it. If you pull it off, sure, great investment from a cash flow point of view, but you've still got way more debt than the value of the asset. So massive valuation issues. And also, if you need to sell inside 3 to 5 years, chances are you're losing hundreds of thousands. So the cash flow is negligent. So be very mindful trying to tick every box. A lot of groups will talk about high cash flow, great tax deductions, high growth. We'll give you everything. It's impossible. High growth is generally at the cost of cash flow. High cash flow is generally at the cost of growth. Nothing's perfect. So just be mindful when you're looking at properties, be very careful of that. Tourism focused areas, for us, we're not talking about anything within 90 minutes of a capital city, which I've hammered now, but we're very mindful that domestically tourism is going to boom. And we don't need to be a demographer or a social trend expert to know that. There's nowhere to spend your money overseas. It's all going to flow domestically, and people are hanging to go on holidays and spend time with family and loved ones. So from that point of view, the coastal regions are pumping at the moment. We're getting a lot of calls from clients saying, we want to buy in Cape Willamette. Have you ever been there? No, but we want to buy there because it's on the beach. We're hearing it all the time. So and then they'll text us an hour later and say the property sold. It was only on the market for 2 days. So these coastal regions are performing exceptionally well. But if they're purely tourism regions, the problem is you're probably buying at the peak, and there's always going to be a trough in these areas, because once we do start to travel again and things open up, there's going to be a lot less money flowing to those areas. So be really mindful of that. What can happen in a strong market is all locations end up being perceived as equal. And what that means is we have this issue where main road properties are selling for a similar price point as the houses 2 streets back. Everyone tends to be pricing everything the same. But then when the market drops, that's not the case. All of a sudden, the values drop significantly on the busier roads than they do on the side streets. So we have to be really careful of that. And if it's affected by freeway train lines, you've really got to price it aggressively and be aggressive on your negotiations. It's a smaller market that will buy that property. Off the plan for the reason that prices may be slightly less than what they were last year, but it's such a difficult space to to put value on an asset. So you might say, yeah, they wanted 600 last year, now they'll take 550. That's not a 10% gain because maybe it was already 15% overpriced and now it's just 5% overpriced. So it's very, very difficult space to navigate. And we're also not sure where the market's going to be in 12 or 18 months' time. There is a bit of uncertainty out there over the medium term. So if you sign a contract today and it doesn't settle for 12 or 18 months, there could be some risk there. Keep an eye on areas that have got a lot of mortgage stress. The data is available online, and also areas with low owner occupiers. Anything less than 75%, I'd be very, very careful because investors may sell off with a lot of the JobKeeper and the mortgage freezes coming back on. And also if tenants are hard to get your hands on and cash flow is weak, you could have some issues if stock comes on the market in those areas. So I'd like to throw it over if anyone's got some questions, because I think one of the key things is everyone's situation's very different. And we do find in some of these quick Q&A sessions, we do get some very, very specific questions. But if you've got anything you'd like to throw out, feel free to drop a couple of questions in on the chat. I mean, if I can throw a couple out there that we typically get, and hopefully they're valuable for people. The first one generally be, what happens if I think I bought the wrong property already and you're holding on to an asset that hasn't performed? I mean, the key thing that we always say to clients, if you wouldn't invest in it now and it hasn't performed over the last 5 years, which has been when the property market's been at its strongest, it's probably not going to perform. And one of the biggest barriers we see with most investors is they tend to run out of debt capacity. So as a blanket rule, that tends to be a bit of a framework for investigation. If you've got a property, it hasn't performed in the last 5 years at all, and you think you're running out of debt capacity, it's definitely worth assessing and looking at. The other one is a property that's highly negatively geared that hasn't grown. So if it's costing you money week in, week out, it's affecting your cash flow and it's not performing, they're probably the two biggest triggers that I say, you know, it's time to take a look at your portfolio. The other one tends to be Queensland. People say, oh, we've got friends that have invested in Queensland and it hasn't performed. And you're saying Brisbane's a good investment. Brisbane and Queensland are different investment strategies. Queensland could be anywhere. It could be somewhere like Townsville, which is past its peak and unfortunately not performing, or it could be somewhere like Gold Coast, and in Gold Coast, it could be a house and land, it could be a block for subdivision, or it could be an apartment. So you've got to be really mindful not to compare your strategy with other people's strategies, because you might have the right plan in the right area and they might have done something incorrectly in the wrong area, and then they'll jump on and say, hey, that's a bad idea. So sure, definitely listen to as many people as you can, but just be mindful to ask some really granular questions about what kind of property style did you buy, where did you buy it, when did you buy it? If it was new property, peak of the market, small town, you know it's not the same as buying in a capital city with, you know, north of 2 or 3 million people. A couple of questions are floating through. First question, looking at selling this year, is there a better time to put a house on the market now or later in the year? Will it make much difference? Depends on the postcode you're in, but generally speaking, stock levels are still pretty low at the moment and there's a heap of buyer activity. So if you go to any open homes in your area at the moment, you'll get a feel for how many people are showing up to them. So I'd say do a few open homes close to where you are and just see what level of inspections they're getting. Most areas, we're seeing a lot of people attend open homes at the moment. There might only be a few serious buyers there, but those few serious buyers get really spooked by the volume of people that are there. Which means it encourages them to pay bigger prices quicker. So yeah, I think now's a really good time. I've got some other questions here. For an investment property, is it better buying as new as possible or a house a few years old is still okay? It really depends on your game plan and whether you're looking to buy an older property with a bigger piece of land or a newer property that might have less maintenance. The hard thing these days is you can't claim the depreciation on a newer property if you haven't built it or renovated it. Once again, I'm not an accountant, so seek advice from the wonderful team at Highview. But it's not as tax effective in most cases it would be from buying new. So it really depends on what your approach is and what kind of outcome you're looking for. So it comes back to that tailored approach. But generally speaking, older properties are in better locations than the newer properties, which are at the extremities of the suburb. And the older properties tend to be on bigger pieces of land, so they tend to perform better as well. Next question. Do you look at property that has potential to subdivide in the future? 100%. When we're meeting with clients, it's all about working out what's important to them, what their risk appetite is, and what they're comfortable with. And if a client's comfortable, I'm sure there's just a test fire alarm going off here, guys, so I'm going to stay and assume that the place isn't on fire. If I start running, I'll take my laptop with me. Look, it really depends, but yeah, subdivision sites can be hugely profitable, or they can also be quite high risk. And when I go back to earlier to comment around cash flow and growth, they might have a better growth, but you're definitely going to give up some cash flow in the short term, and you've got to make sure you can afford that and make sure it's worthwhile as well. First home buyer question: would it be smarter to purchase in the next 12 months with less savings, or wait until more money is saved in around 24 months from now? That question really comes back to your ability, how quick are you saving money? What type of property are you wanting to get into? You might be able to afford a unit now, but you're rather holding out for a house. But also make sure you've tapped into all of the support you can get from a first home buyer grant, from a stamp duty exemption standpoint, and whether you can access the first home buyer no LMI as well. I think there's only 10,000 every 6 months, but the ability to apply for that through your funder, through your broker at Highview, means you might be able to get in with 5% deposit and no stamp duty, which is pretty amazing. Last question here is thoughts on long-term capital growth on houses in affordable beachside suburbs, Seaford, Frankston, versus affordable suburbs in the southeast, Narre Warren, Berwick, and Pakenham. Yeah, great question. And we try not to be too opinionated on picking suburbs to outperform other suburbs, because there's just so many nuances that are hard to predict. But if I had to weigh them up from an affordability and price point standpoint, I think Frankston for me would be the pick of the bunch. I think Frankston's still at a reasonably affordable level, and I think it's got a lot of room to move. And we're seeing a significant amount of first home buyers wanting to buy and renovate and move into those areas that are going to have rising incomes in the next 3 to 5 years. The Bayside living aspect as well is more valuable now than ever, and the access to the peninsula, which is performing exceptionally well. And then you've also got pretty clear transport and arterial routes back into the city and back into Ringwood, which is obviously another activity centre. So if I had to pick one out of those, I'd pick Frankston personally. I did say last question, but there's one more here, so I'll punch it out because we've still got a couple of minutes. Actually, that's probably a bit more of a personal situation question. I don't feel comfortable reading out all the details, so I might park it there and just say, if you'd like to catch up with myself, it is on offer for any of the attendees this evening. Please speak to your advisor at Highview. More than welcome to reach out direct, and they'll pass on my contact details, and happy to allocate a 30-minute meeting to anyone just to flesh into your situation a bit more deeply and see what kind of direction and experience sharing we can give. As I said before, we've got a research team that are big on research and opinions. I tend to stay more around the strategic piece of what clients do with their money and where they invest. So more than happy to allocate the time. For anyone that's interested, just go through your team at Highview. And I just want to say thanks to the team at Highview for putting this on. It's never easy with day-to-day work to put on these kind of events, but I think there's one thing that they do exceptionally well is make sure they educate and advise their clients so that they make better decisions, which is good for everyone. So thanks so much for joining, and we'll hope to see you at the next event. Thank you.